The incoming data support the view that the economy is able to sustain a reasonable cruising speed. We will ease the pressure on the accelerator by gradually reducing the pace of purchases. However, any need to consider applying the brakes by raising short-term rates is still far in the future. Overall, the committee believes the downside risks to the outlook for the economy and the labor market have diminished since the fall, but we will continue to evaluate economic conditions and risks as they evolve. Today, the committee reaffirmed its expectation that the current exceptionally low range for the funds rate will be appropriate at least as long as the unemployment rate remains above 6.5%, so long as inflation and inflation expectations remain well behaved in the census described in the FOMC statement. As I've noted frequently, the phrase "at least as long" in the committee's interest rate guidance is important. The economic conditions we have set out as preceding any future rate increase are thresholds, not triggers. For example, assuming that inflation is near our objective at that time, as expected, a decline in the unemployment rate to 6.5% would not lead automatically to an increase in the federal funds rate target, but rather would indicate only that it was appropriate for the committee to consider whether the broader economic outlook justified such an increase. A strong majority now expects that the committee will not sell agency mortgage-backed securities during the process of normalizing monetary policy, although in the longer run, limited sales could be used to reduce or eliminate residual MBS holdings. I emphasize that given the outlook and the committee's policy guidance, these matters are unlikely to be relevant to actual policy